Hey everyone, and welcome to another webinar from the TIE. Today we're going to be talking about an institutional guide to crypto staking, and I'm very excited to be joined by an incredible group of panelists. First, I have Alyson Russ from Figment, I have Luke Dorney from Blockdaemon, and I have Felix from Chorus One. It's great to have all of you guys on today. Before we begin, a quick disclaimer: the information contained in this webinar is for informational purposes only and should not be considered as investment advice. But why don't we get started? It'd be great if we can go, Alyson first, then Felix, then Luke is how I'm seeing you guys on my screen. Alyson, can you give us a quick introduction about yourself, your role, and your firm?
Yeah, thanks so much for allowing Figment to be on stage here with you today. So I'm Alyson Russ. I work at Figment. I work on our growth team. So I support our asset management, hedge fund, and VC clients that are looking to stake their tokens. Figment's a blockchain infrastructure company, and we're most well known for our protocol staking infrastructure, supporting 50 plus blockchain networks and many institutional investors who are looking to stake their tokens.
Felix, you want to go next?
Yeah, sure. Thanks for having me. I'm Felix. I'm the Chief Commercial Officer at Chorus One. Chorus One is a Swiss-based staking provider. We're on about 35 different networks. We're also mostly focused on providing staking to clients that want to participate in crypto networks, don't have the infrastructure, and we also do venture investing and have a big focus on research and governing the new kind of decentralized networks that we are a part of.
Hey everyone, good to be here. My name's Luke Dorney. I'm head of European sales for Blockdaemon. Blockdaemon is one of the world's leading infrastructure companies that enables institutions to access blockchains in a fast, scalable and flexible way. Since 2017, we've been building and acquiring businesses that allow our clients to run tech and infrastructure to access the entire value chain of crypto. So we have a crypto on-ramp tech product. We have access to 50 blockchains where you can run your own nodes through our platform. One of the largest parts of our business is our staking business, which has been up and running for a few years now. And we have an MPC tech solution that allows our clients to self-host wallets on their infrastructure. So good to be here today. And obviously we're focusing on staking today. So looking forward to getting into the detail on that.
Yeah, so let's go into it. So, we have a pretty diverse group of listeners. We have a number of funds that are newer to crypto, more traditional hedge funds and venture funds. We also have a large number of funds that are actually very deep into crypto. So why don't we start at a pretty high level, and as we go on, we'll get a little deeper. But at a very high level, and anyone can interject here, can you just explain what staking actually is, how it works, how somebody does it, why anyone should care, and how it generates a yield?
So I'm happy to sort of kick it off here. So I don't think that you can talk about protocol staking. And I actually think it's very important that we clarify that this is protocol staking that we're talking about, because staking is a very ill-defined word. It can be associated with things with lending, DeFi staking, but what we're talking about is actually securing the blockchain. So I don't think you can talk about staking without actually talking about its predecessor or proof of work or mining. So someone or something has to maintain the blockchain. And on Bitcoin, that's done through mining, which most people are very familiar with mining rigs. Maybe you've seen pictures on TV. Many people are familiar with that. It's highly energy intensive, capital intensive. There is another consensus mechanism called proof of stake. And nearly every other blockchain is run by the proof of stake consensus mechanism. So how it works, instead of miners securing the blockchain, is actual stakers or token holders, or those that own the cryptocurrencies, stake or lock their tokens onto the network, and essentially propose and attest to blocks using the infrastructure that all of us here today run, or perhaps they run it themselves. So it's highly participatory. And you earn a reward for working on behalf of the network. I'm sure others here want to jump in maybe and provide some more color.
Yeah, I was going to just add to that. I think, the key part here is not using computational power to solve complex mathematical questions like proof of work does. The move to proof of stake a few years back was really, committing computational power to contribute to consensus mechanisms. And that consensus mechanism here in proof of stake is putting your tokens or your capital at stake. And essentially that is acting as collateral when validating and running those blockchains on proof of stake, and allows you to participate in the governance of that network as well. So, it's staking is twofold. It's participating in the network, and then it's really, earning a yield off the back of your participation.
Yeah.
And so, please, Alyson.
Yeah. So one of the things you said is like, where's the yield come from? And so, mind you, this is how I think about it. In crypto, there are things that you can do that have been done in traditional finance before, ways to earn yield, again, lending, all sorts of activities. But the concept of protocol staking, right, does not align with like a traditional finance activity. So it's a completely new way for an institution or an investor to earn what we call actually a reward. I think as an industry, we're actually trying to get away from the word yield, although you can think of it akin to that. And it comes from the actual blockchain. It's inflation. So every blockchain has an inflationary component. A newer blockchain might have an higher inflation to draw in stakers, right? They want more stakers on a network. The more eyes and ears you have on a network, it tends to be more secure. The other part of the yield or reward is actually derived from transaction activity. So as people use the network, operate on the network, that also increases the reward rate. So again, it's not done through other sorts of financial engineering. It's inflation and transaction activity. And that allows the reward rate to remain very, very stable. So if you were to look at reward rates, say 6 months ago on these networks, they would tend to actually look, for the most part, very similar to how they are today. Even when you saw volatility pick up in the crypto markets through the spring, most recently with FTX, again, protocol staking rewards rates have remained stable because it's all derived at a network level. In fact, on some networks, you actually saw the reward rate uptick slightly because you saw increased usage. So I think that's very important for people to understand that, again, like it's a very transparent and stable form of yield driven by inflation and activity.
And so, Felix, I'll look to you to kick this one off, which is, what are the different ways that an individual or fund can stake, and what are the benefits and drawbacks of each? So I think maybe it was Luke mentioned, basically allowing clients to, running a validator on behalf of the client versus a client actually delegating to a pool. So can you kind of speak about the different ways that somebody could actually stake?
Yeah, sure. Happy to. So, right, basically this concept of staking, in the end, you do it on the network by interacting with some sort of smart contract that is on the network or directly interacting with the protocol in some way. And you can do that either by running your own, like spinning up your own nodes that then will participate in the maintenance of the network. Or if you don't have the infrastructure knowledge or a partner that does that for you, you can also delegate your tokens to someone else. So basically, most of the protocols have a built-in feature that allows you to basically specify the party that should essentially do the work for you. And then there is a kind of programmed in the fee that goes to the one that runs it for you, and you get the staking reward minus that commission fee that we call it in proof of stake. And so really the options are either running your own node using some partner with a white label kind of service, or delegating to one of the publicly available validators. And then on top of that, there is basically like a newly emerging option called liquid staking. Maybe we'll get into that, where you can essentially also interact with a kind of aggregator service or product that distributes the stake between different providers and also gives you the ability to use your stake in other financial applications. So I'm thinking maybe we'll get into that a bit.
Why don't we just get into it now? Why don't we just go into liquid staking now if we're already going that direction? So you can, I mean, if there's anything you want to add to it. So
no, yeah, exactly. So basically, liquid staking can be thought of as a sort of like aggregation mechanism. You stake through the liquid staking protocol, and the liquid staking protocol itself distributes across a variety of staking providers. So, for example, it could be that it works with Blockdaemon, Chorus One, and Figment all together, and distributes the stake evenly across those. And then, in addition to when you do that, you receive a kind of a token that represents your part of the liquid staking protocol. And this liquid token, again, you can use as collateral in financial applications. So you could use it to lend it to do other activities in the decentralized finance ecosystem. The benefit here being that by creating this kind of representative token, you get rid of some of the limitations that are inherent in staking. So there are lockup periods and other things that kind of limit the liquidity you can get on staking generally. But with liquid staking, you basically unlock some of this the capital efficiency there, and can reuse the collateral. But it also adds on like a bunch of risks and has like
well, I was about to go into. I mean, I'm sure a bunch of folks in the space remember Stakehound. You know, and about I don't know, probably about a year ago at this point, you know, Stakehound was offering SDETH and a bunch of others, and apparently lost their users' private keys and lost about $70 million. So curious as to what are the risks of staking, if any, and then what are the risks of liquid staking and how do they differ?
So I'll just quickly jump in on that, and I think it does go back to your original question, and you know, on traditional staking. So I think most of your audience potentially are token holders, or potentially could be token holders, right? And
the majority of folks listening are probably already have some exposure to the asset class.
Okay, so and those institutions or firms are going to be holding those tokens somewhere, right? Whether that's on an exchange, whether that's with a custodian or an MPC wallet provider or a regulated custodian, or whether they're running their own self-hosted wallet. So in order to stake your assets, you need to be able to interact with those firms that I've just mentioned, the exchanges, the custodians, the wallets. And you know, there's various different ways you can do that, and I think it all depends on your risk profile. So, for example, if you wanted to, if you held your assets on an exchange, and obviously that's a bit of a risky business at the moment through this period, right? If we're going through the FTX situation, but you're centralizing your asset on those exchanges, and those exchanges could stake those assets for you, and they're going to take a cut off the back of the reward that is earned. And you know, you take a risk on that exchange where you're holding those assets, and you know, from a staking perspective, you might like that from a user interface perspective, and easy for you to stake those assets, but essentially you're taking some risk on that counterparty where you're holding those assets. And then similarly on a regulated custodian as well, you know, again, you're centralizing that, but you're separating that away from exchanges. You're potentially, you know, when you're holding those assets with a regulated custodian, potentially those assets are insolvency remote from that custodian, and you can stake those assets out of your custodian. So the reason why I'm talking about this is that infrastructure providers like us work with the exchanges and regulated custodians, and obviously from a self-wallet perspective, you could stake to our infrastructure directly from there. So you have different options depending on your risk appetite and where you're holding your assets. So I think that's one important thing. The last thing I'll mention on there is that all of us as infrastructure providers, or especially from Blockdaemon perspective, we are non-custodial, right? So we don't have access to your keys. You are staking from a wallet. Those assets stay in that wallet, but you're essentially bonding those assets to a validator, which allows you to earn a reward. But you know, from an infrastructure provider perspective, you know, your risk profile doesn't change to us because you know you're holding those assets at that custodian.
I think Luke makes a really, really good point, and that point cannot be hit home enough on protocol staking. Is the non-custodial aspect is really, really important. And as you're thinking about where you're deriving risks from, the fact that it's non-custodial, you can argue makes it a maybe a safer place to place your bets, because there's that non-custodial aspect. Either you're doing self-custody or you're using a trusted custodian.
And I think in that regard, I mean, my kind of way that I've looked at protocol staking is like, well, if you're not doing it, you're kind of missing out on the inflation. Like, you're basically not, you're going to get inflated away if you're not staking. So I'm curious if that's something that you guys, kind of think about, or is that something that clients talk about a lot?
Again, I think it comes down to preference on the token holder, right? So sorry to keep coming back to this, but it is down to risk appetite, right? So what is your investment profile, and do you want kind of a lower risk investment into a predictable on-chain revenue from a reward perspective on protocol staking, or do you want to allocate that capital somewhere else? Are you deploying that somewhere else where you might make a high return but could be a little bit more risky? And also this comes down to, if you're a firm, it's not just about the reward, it's also about participating in the ecosystem, the culture, the governance, the community. And I think that does have to be taken into consideration when thinking about, the protocol.
So from a governance perspective, actually, that's very interesting. So for anyone who's unfamiliar, you can think of governance in crypto kind of like proxy voting in equity markets, for lack of better words. But one of the challenges that we've had within crypto governance is the centralization of it, right? Where one big VC fund who holds a large percentage of the assets goes out and places a vote and basically wins the governance proposal. Or, I think my team is going to release some research on this. We haven't already. We found that basically anything that Sam voted on in the Solana ecosystem got approved, and he was able to get like a ton of grants for other ecosystem projects that he was invested in, right? And so as staking providers and as infrastructure providers, are you guys making governance decisions on behalf of your clients? Are you allowing your clients to participate and vote directly? How does it actually work?
Yeah, I think I can speak to different. It depends on the network ecosystem. So obviously we have different proof of stake networks that have different governance mechanisms. So some of them work by like an on-chain governance system. So basically that the tokens that you hold represent your voting power in also the governance process, which is, for example, the case in Cosmos networks or in Polkadot or in some of these networks. In others, the governance process is actually more off-chain or kind of not as formalized with the tokens. So for example, actually even Solana or on Ethereum, most notably the governance system is kind of a meat-based thing, or like something that happens between the developers and on forums and like on a social layer, not directly on the network, kind of with voting on chain. But in the cases where the voting is on chain, often the way it is implemented is that the stake from the validator is the one. So the validator is voting, and the delegators, or the people that stake with this validator, inherit the votes of the validator. So initially, yes, we could be voting. We could be seen as voting on behalf of your clients. That also works if you're a white label operator. You have your brand represented on chain and receive basically stake from your clients. Then you would initially vote on their behalf, but depending on how they custody the funds and how it's all structured, they can generally override this vote and vote by themselves. So the way we, and I'm sure also actually all the other teams here, usually approach it is to give the choice to the customer, but often in some of the networks where we run our own public nodes, so the ones that you can delegate to that are called correspondent in our case, there we will do votes based on our assessment of the network and our expertise, and we'll also kind of share why we vote a certain way, and we'll kind of inform people about the vote. But ultimately, yes, they inherit the vote, and can then, if they don't agree with us, switch it. But obviously, I guess one of the things would also be that maybe some people that want to understand deeply, or like kind of delegate to someone that has a similar kind of approach to governance than this party might have. So that's what I would say to that.
Yeah, I was going to just add as well. Like, I think if you're centralizing your staking on an exchange, my understanding is that potentially you could be giving up your right to vote through those exchanges as well, right? So again, it comes back down to what is your preference? Is it ease of user interface and just getting access to that yield through an exchange where potentially you're earning less reward and you're not going to be kind of you're not going to have the ability to for those voting rights, versus a much more decentralized view of the world where the setup could be a little bit more complicated, but actually you get more rewards and you actually participate in the network. So I think it's a mixture across the market.
And so, my next question is, what do you need to know before choosing a staking provider, right? Like, what actually differentiates all of your firms from one another, and why should we trust you specifically? So I think everyone should answer that. So Alyson, why don't we start with you? And
yeah, I think the good news is there are great providers to choose from, right? So a few things. Well, let's start with risk. So in my mind, there are two big risks that you face in protocol staking. The obvious one being slashing. So this is loss of principal, largely due to faulty infrastructure, but it could be due to malicious activity. So the question you should ask your staking provider is, have you ever been slashed? If there was a slashing event, what happened? How potentially did you compensate your delegators? Do you have slashing coverage to compensate people in the event that risk happens in the future? The other thing, which is not provider specific in regards to risk, is the unbonding period. So there is a liquidity associated with every single protocol. We as validators cannot actually, we can't change that. It's set at a protocol level. So you have Ethereum right now, which has an indefinite illiquidity period until Shanghai. You have Solana, which is like 2-ish days. Again, that's a risk you have to be aware of. That's maybe separate and distinct from providers, but something, if you're engaging in protocol staking, you need to be conscious of. Secondly, outside of slashing, is like, what are the services that you can be offered beyond just the infrastructure itself? So is there reporting? Do you have an account management team? Are there maybe other blockchain infrastructure services that might be interesting to you? So those are all sorts of, I think you have to ask yourself as an investor, what is important to me? Exchange staking, it's not great for a lot of reasons, but it's also really easy. And so if ease is your quickest way is like the highest and best use case for you, then like it might be a feasible option. And right, there's still great exchanges out there. So when you kind of like do some self-reflection, just as you would be picking any other infrastructure provider or provider for your business, like those are the same sorts of questions you should be asking your staking provider.
Luke, why don't we go to you next?
Yeah, I mean, all of the above. I think that's a view that we take around guarantees around slashing. I think I'll come at it at maybe a little bit of a different angle, and it's like, if I'm putting myself in the shoes of your audience, even if you staked on an exchange or with a custodian, the likelihood that some of that flow is going to come through to any three of us on this call here is probably quite real, right? So we work with a lot of the exchanges and custodians, and in the background, they're actually flowing through some of that flow through to our validators. So, you may be looking at an exchange or signing a contract with a custodian, but in effect, they might be using us in the background. But and what that really comes down to, and especially when we speak to the custodians, exchanges, and regulated institutions, is what is the trust and track record of your firm? Who are you backed by? What's your track record on nodes and your validators, the longevity of your business. Have you had any slashing events? What's been the downtime of your validators? Like operating validators is a pretty complex thing, and generally why that's outsourced to experts like us. So I think the trust and track record as you're going through that process, looking at staking providers is important, and then down to the security and the risk mitigation layers around your platform, monitoring of your infrastructure. What are the failover procedures if things do happen? And if all else fails, what are your guarantees on that slashing and the liabilities? And I think the second thing, well, probably the last thing I mentioned is the ease of integration. So, we talk about what is the path of least resistance to start actually earning a reward. And if you're an institution that is holding your assets with a particular custodian, how easy would it be for you to sign a contract with Blockdaemon, stake to our validators out of the custody accounts that where you're holding your tokens in those custodians? So we interact with multiple different players within the ecosystem to try and make it as easy as possible for institutions to be able to stake their assets through our platform, but out of the custodial solutions that they're already holding their assets with today.
Yeah, I don't want to repeat too much. I think both Alyson and Luke made some great points that obviously relate to, let's say, security and also this integration point, which I think is very great, right? You want to maybe go to market quickly with your stake. You want to get there fast, so you need to maybe work with people that allow you to do that. I think one other differentiator that exists, maybe that we haven't talked about as much just now, is also maybe in the risks terms, you might be interested in geographical distribution. So that relates both to your nodes in terms of where do the actual servers sit? Do you want them to not be in the US? Do you want them to be in the US? Do you want them to be in Asia? Things like that can be things that you could achieve. And then also the jurisdiction of the actual staking provider. Where are they registered? So for example, we're a Swiss-based entity. Others might be different, and also as an institution, especially as you're talking about higher amounts of stake, maybe you want to also diversify in these directions. So that is one thing that maybe is worth mentioning. And ultimately, I think so we talked a lot about the risks and these kind of things, but ultimately there can be differences in rewards you earn. So far, it's actually mostly the same, but as the blockchains become more used and more transactions flow through there are essentially ways that some node operators that might perform better on certain areas, and then there could also be a difference in yield. This is also a pre-emerging area where also the tooling gets better.
Are you referring to using MEV to boost yield?
Yeah, exactly. Exactly like MEV. Basically, this concept that some of the arbitrage and liquidations and things that happen on the network, the returns from that usually can go back to the stakers as well through the validators that run this special MEV software, like for example Flashbots on Ethereum. And depending on your provider, maybe they don't run it, they run a certain version of it, or they engage with it in different ways. There can be differences in the yield.
How big is the difference? So right now on ETH as an example.
Yeah, right now if you run, so basically there's this option, you can run MEV boost or not. If you do, about 10% of the yield comes from MEV boost. So it's something like, I guess 6% around just from normal staking. And then if you add the MEV boost, or if your provider supports it, then it would be 6.6 or something. Might be a little bit off here, but it's around that. And these numbers can, we're not really sure. It's very early in this market, so really this concept of MEV even just exists probably since last year, since DeFi really took off. And obviously in the future, this might play a bigger role, or maybe it also will play a smaller role as this market evolves. But it's definitely an interesting area that we also have, for example, invested a bunch of research in and written a lot about. So that I think is worth mentioning as a potential other differentiator.
So how much additional return can an institution expect to earn staking? I know you just mentioned 6% on ETH, right? And I know we've talked kind of high level, but what are, from a protocol perspective, I mean, I know, maybe Luke, will start with you. I know you mentioned Blockdaemon offers 50 different protocols, which is insane. I didn't even realize there were 50. So what is that? Like, what is the range of yield there? I mean, I think Alyson, you spoke about earlier, the fact that earlier stage, maybe there's more liquidity incentives to, higher yield or higher incentives to participate in staking of the network. So how big of a range is that? And what is usually the feedback or pushback on why somebody wouldn't stake? Like, especially to take a VC fund for perspective, right? Like if you're a venture fund and you invested in an asset early stage and you're locked in that asset, what is the reason somebody potentially wouldn't stake? So I guess two questions, which is yields, and then why do people often or ever push back against staking?
Yeah, so I think the range it can be quite wide ranging, right? And as Alyson said, like when you look at some of the early stage, some of the APY is higher, but I think what we see the decision making processes from our clients is again around deploying that capital to stake versus potentially deploying that capital in a different type of structure, right? So they could lend those assets and earn a reward. Now, obviously, the lending market is in a little bit turmoil at the moment, right? So this is a bit more of a safe haven from a reward perspective and a little bit lower risk. But the reason around that decision making process is, okay, how much yield are going to earn? So is it Solana where it's around 5-ish%? Is it Polkadot, which is around 13 or 14%? Avalanche, which is around 10%, or I think between 9 and 10%. But all of those have got different lockup periods and different reasons why potentially you wouldn't want to lock up your assets for a particular period of time. So using Polkadot as an example, if you stake Polkadot, takes about 24 hours to start earning rewards, but can take 28 days to actually unbond, right? So if there's a market event and you've got those assets locked, and as we've seen over this period, if the market starts to tank, you actually can't get access to those assets. So you've got that decision-making process around earning a 14% yield, reward on that versus the potential opportunity loss of not being able to kind of sell those assets.
And so how well can you hedge your risk then, right? I mean, if lending markets are tightening in crypto, right, and you have assets staked in DOT, and let's say there was some sort of black swan event that impacted, how do you go about actually hedging that risk?
Yeah, you're getting into trading strategies now, which is not really my really my forte. I don't know whether anyone else on the panel's got an opinion on that.
Likewise, but I can speak a little bit. That's where things get tricky. It's right, like this. That's where this market is still so nascent. It's one thing if you're staking ETH, like maybe there's some futures out there that you can use, but when you get into some of these other protocols, it is really hard to hedge that price risk. There are some options out there, but that's why you really do have to take like the time horizon approach. I think protocol staking aligns beautifully for VCs. You're long-term holders, you're really into the ecosystem and governance. You can't sell out of it anyway, likely. So you tend to see people stake most, if almost not, if all of their tokens, if they can do it. Hedge funds, they have to be a little bit more selective depending on the strategy, because when it comes to hedging out that price risk or what sort of turnover they have in the portfolio, that's where things get a little bit tricky. And mind you, you are still seeing developments outside of like protocol staking that are, helping in that respect. But maybe you do things like choose something with a shorter unbond. Maybe you allocate a smaller portion of your strategy to staking, but I think the liquidity aspect is really, really key when you get into trading oriented clients. And that's why the liquid staking market and strategies that Felix was talking about earlier, I think are very, very powerful for those clients.
And so I guess a similar and relate, Felix, were you going to say something? I saw you just unmuted, sorry.
Not too much to add, I guess. Yeah, right. I think I really agree with Alyson here that, for the most part, from the network perspective, the reason why all these unbonding periods and everything exists is because you want the people that provide the collateral to be like long-term oriented and kind of grow the network. So a lot of these are also there to guarantee the security of this decentralized network. And then basically the holders or the people that participate should have that mindset. So that's kind of what's trying to be incentivized. And so it lends itself to that kind of holder. Now, of course, you can come up with some structure to take out the risk. I think these markets are really just evolving. Probably for Ethereum or Solana, you might have already like some options somewhere that you maybe can hedge some of the downside of just the price crashing a lot. But for the most part, if you're like a investor in that asset and staking kind of makes sure you're not getting diluted, as you also mentioned earlier, Joshua. So it's really like kind of aligned with that kind of holder. I would just reiterate that, I think.
I do actually want to add one point because I think it's really interesting. And so we're talking in terms of institutions here because we all serve institutions, but you can stake one token. The beauty of protocol staking is it is meant to be participatory. So while we all work with institutions every day, know that there's a whole host of retail delegators out there that are also really important. And as you're thinking about interacting in these markets, you have to keep that in mind, that the barriers to entry are really low, and that's intentional from a protocol level. Right, this is developed to secure the network. Like this protocol staking was not developed for market neutral hedge funds, although they can benefit. So I just think it's a really interesting point, and sometimes like we lose sight of it, of just how participatory it is for everyone outside of the institutional world.
Yeah, I think it's a fair point. I think we get desensitized to the conversations a bit, right? Because we're talking to these institutions every day. So you've got digital asset managers that are launching, exchange traded products, right? That are tracking a yield and offering kind of product, structured products on top of that allow you to get access to yield without actually kind of staking the asset. And that's where, like with those types of products, that's where the liquidity piece is like so important. So, and with the lending market drying up a little bit, those products, it makes it harder to grow those products. But I think Alyson's right around, the retail investor being able to stake their assets on platforms and making their own decisions is like a very easy thing to do. But the institutions have got, much more a process they've got to go through, right, around the risk appetite and for their investors that they're operating for, in terms of how they stake those assets.
So a couple final questions. One that actually just came up, which I didn't even have written down, is what about like the kind of aspect of the fact that assets are being commingled? Has that ever been a problem for an institution, or is that, I guess that's why you can run a separate validator for an institution that has problems with commingling of assets?
Yeah, I think that is possible. I think it's only really a problem. Yeah, I wouldn't, I mean, it could be a problem because actually it gets harder to calculate maybe certain things of like which rewards come from where. So, but that's actually more a problem on our end, like the provider side, that we have to like work that out. If there's issues from the institutional side, there might be like an impression of that. I don't actually know if there's any, like, maybe there's like, just to be sure that you're on the right side, rather don't do that. And I guess especially like some customers might really also not want to receive delegations, what we spoke about earlier, that anyone could delegate to your nodes, then and often in the blockchain systems you actually
I'm thinking
cannot,
like if you had an OFAC country, right, and you had commingled assets, right, and you didn't want to have assets that are commingled with the Iranian government or something, right? and you're concerned about receiving rewards. So I'm just curious. This just came to my mind if that's been an issue or a thought among institutions.
Yeah, I think, or maybe Alyson.
Gosh, that's like a landmine, and I don't think any of us want to touch. I think it's a very good point. Right, there's the regulatory. We're operating in gray areas with imperfect solutions. There are ways that we could potentially address that for clients. All of us white labeling, things like that. Again, it's not perfect. Staking's still permissionless. And like, look, there's like iterations of that. You can say the same thing with like what MevBoost is trying to solve, right? Like, where do you draw the line from pooling to proposing to attesting? Like, you can do the best with the technology that exists. I don't think that those things are going away, but it's a question that we might be hearing more of from our institutions.
And also, don't forget the when we talk about assets being held somewhere, right? These assets are being held at the custodians, right? So they're going through that process, that KYC AML process from a regulated perspective, but the point around being able to delegate to any validator, you can't necessarily switch that off, but you can do some things to deter people to actually delegate to a white labeled validator, right? So we do have some of our regulated institutions saying, look, I don't want to delegate to your public shared validator. I've got my own obligations to my regulator around, how I'm setting up my business, and I want my own white labeled validator, and I want to put some settings on that which deter others sort of delegating to that validator pool. So there are ways of getting around that, and I think it goes back to Felix's point around, you're deterring people to send staking to your validator, but also the location of that validator as well, right? So if you are a highly regulated institution and you want to have a white labeled validator and you want that to be in Switzerland, for example, then you can do that. And I think that a lot of those institutions are starting to push the button on that a lot more.
So a few final questions, maybe we'll go speed round. The first one is on the Solana incident a few weeks ago, where, there was seemingly going to be a large number of Solana assets that were unstaked. But then, all of a sudden there was some issue with the hosting provider that was hosting a lot of these validators or something like that, right? And basically the epoch was delayed. And so to me, that screams centralization. And I'm curious as to your take on that. And if somebody can just delay, on staking, I mean, theoretically that, like, and I'm not an expert at this, which is why I have you amazing people here to give me the answers. But like, to me, that presents an interesting risk that we haven't talked about yet, which is how centralized these entities potentially are and what they can actually do to stop a large amount of assets from unstaking.
Yeah, I that's a really interesting scenario, because I think it also kind of coincided with the whole FTX collapse. So a lot of people were thinking, oh my God, now everyone's going to dump all their soul. But actually, a lot of it was related to the Solana Foundation also. They have this delegation program where they delegate funds to newer validators, like teams that start running nodes to kind of help decentralize the network. And there is this one provider, Hetzner, that is like a cheap bare metal provider, data center, kind of where a lot of people have run their nodes, that became crypto unfriendly suddenly, or like over the last few weeks in the bear market essentially, and tries or like kicked out all of their clients there. So these teams that the Solana Foundation initially delegated to essentially were kicked out of this provider, and the nodes were offline. So they unstake from them to redistribute that, and that all just came together. So I guess, yeah, that was the reason for this one. But still, obviously, there was a certain way, a little bit centralization also on this part, where which are the actual data centers where the servers are then located, which, like, some of the cheap providers.
Yeah, like what happens if AWS goes down?
Yeah, that's certainly, like, I mean, the bigger providers will, like, our companies will look that they diversify also their data center providers and maybe run it. So we're all monitoring this kind of things too. There's like a lot of different layers where you want to be decentralized, right? Another thing might be the client software that you actually run the validation software. Like on Ethereum, you have like different clients that you can run, and you also don't want all the nodes run on just one client. The same for the data center. So like a good provider will have a setup that is maybe in a data center that not so many other people are, or diversified across data centers and also like geolocations, as we already discussed. So you're kind of a little bit hedged against scenarios like this. But it's certainly, given also how early it still is, and then people like to go with the cheap provider. So that's where there was a certain risk that a lot of people went with the super cheap provider and they turned on everyone. So it's certainly like super interesting dynamic.
I was just going to add as well. Like I think this ecosystem is still developing, right? And there's going to be these, there's going to be an FTX blow up. There's going to be in the background on the infrastructure side some issues that happen, but generally we get through it. But your comment, Josh, about what if AWS goes down, right? It's the same in traditional finance or in any other business. If AWS or GCP go down, then that has a major impact of a lot of businesses worldwide, not just crypto.
I guess totally fair. And so let's end this on a high note. So, obviously a lot has happened in crypto in the last few weeks, to say the least, but what has you most excited? What are you guys each individually most excited about in the market?
I'll go first. I just think that it's really amazing that in all of this noise, which like you can argue has been like the craziest few weeks in crypto's history, the underlying blockchain infrastructure is working. And so that to me is just really exciting. Like in some ways it's business as usual. It's all the stuff on top of it that's having the issues.
Yeah, I think from my perspective, it's similar to that. These events are going to happen. I think ultimately short-term pain, but longer-term gain for our industry, where our ecosystem and the market participants becoming more serious about their structures that they're implementing, or from an infrastructure perspective, but also their audit and their compliance, and more regulated solutions to make this a much more safer place to invest. And these blow-ups, even though short-term pain, definitely long-term gain.
Yeah, I would agree there. I think nothing fundamentally has changed about, like, if anything, it even like shows why we need the decentralized finance infrastructure and self-custody, and which is literally the point of all of it in the first place, that you have a more decentralized system, and like these events just show why once more. And obviously short term it looks like, well, this is kind of, people start to mix up this specific blow up with crypto at large, and it kind of creates this negative sentiment. But overall it's actually like the opposite. It kind of shows why we need these more transparent and auditable systems, that we can avoid these kind of scenarios. And I think that's still all in progress, and we're working on it, and it's kind of already there. Like a lot of the decentralized ecosystems, like Alyson said, are running, and Uniswap works, and all these things, nothing broke. So we're going ahead the way we were thinking. It's just that as the industry grows, other players come in with maybe bad intentions or not necessarily good risk management, and they cast a bad light on the industry, but that's not stopping the progress, I would say.
Awesome. Well, thank you guys all so much. This was great. I learned a lot. So if nothing else, you guys helped me. So I appreciate it. But to everyone listening, big thank you, obviously, to our guests, and please reach out to them. They all do interesting things. They're all slightly different. I know we didn't talk about everything that they do, but we didn't even get into, I was really excited to talk ventures, because I know Chorus One and Blockdaemon does that, both do ventures, Chorus One and Figment both do ventures. I know Blockdaemon now has MPC techs. There's a lot of interesting stuff that these guys are doing. They're all doing different stuff, and so it's definitely worth chatting with all of them. So thank you again. This was great. Appreciate the time.
Thanks all.
Thank you for hosting us.